Hello and welcome everybody to the Credit Union Connection. My name is Sarah Snell Cooke. I am your host, and I am here today with Mitchell Amsler from the CU Capital Management Company. It's a CUSO. Welcome.
Thank you, Sarah. Appreciate it. Thank
Absolutely.
you.
Tell us a little bit about CU Capital Management.
So, CU Capital Management is a CUSO that was started by credit unions and for credit unions to focus on sale leasebacks for credit unions. And what that really is an opportunity for credit unions to raise capital and liquidity through the real estate that they already own and use. And we found that there really was a need for credit unions to be able to raise capital through alternatives that did not exist in the market. And that's why we started this CUSO.
Yeah, always, especially right now, liquidity is super important. And as rates go down, hopefully, I'll be lending again too.
Mhm.
So, walk me through the process. How does this actually work?
Okay, so about two-thirds of credit unions own some or all of the real estate that they use for their operations. So that could include branch networks, that might include administrative buildings like your headquarters building, back office centers, things like that. And credit unions have to carry that real estate on their balance sheet at depreciated cost. That means that they're showing it on their balance sheet at a value less than what they paid for it, often many years or decades ago. However, that real estate, as most credit unions know, is worth far more in today's market than what they paid for it. And so a sale leaseback allows a credit union to tap into that market value of the real estate while seeing no change in their day-to-day operational use of the properties. And so what happens really is a credit union would work with our CUSO to value the property, to come up with uh, a solution that works for both sides, for the CUSO and for the selling credit union. And they sell that property to the CUSO, and then on day one, they turn around and lease it back. And so, from the perspective of their employees and their members, there really are no changes to what's going on. The credit union continues to operate and maintain the properties as they did when they owned them. And the CUSO basically just serves as a landlord that collects rent every month, but doesn't do anything else to interfere with your operations. And so we really feel that having a CUSO on the landlord side sets up a very good landlord-tenant relationship because every credit union that might sell to the CUSO is going to be connected through a first or second degree connection to the credit union owners of the CUSO. And that really helps alleviate one of the concerns that we found a lot of credit unions rightfully had with the idea of selling their real estate to some other party, is that having a CUSO on the other side of that really gives you a lot of comfort that you've got a good actor that's looking out for your interests, that really is looking to help the credit union space. And so why would you do this as a credit union if you owned your real estate? And the real reason here is to raise capital and to raise liquidity in order to help your own credit union from both a regulatory perspective and from a growth perspective. And because we all know that even a credit union that's well capitalized in this market is facing pressure from your regulators to say, you're at 7% capital, you need 8%. If you're at 8%, they want you at 9%. If you're at 9%, they want to understand how you're going to get toward 10%. And so on top of that, in this market too, liquidity has become ever more important as deposits run off in different places. And so this really gives credit unions another pathway to raise liquidity overnight in order to put that into different initiatives for the credit union. And so what you can do with this capital, right, is you can both hold it on your balance sheet for sort of a regulatory cushion, but you can also use that capital to invest back into your credit union. So that could mean opening new branches. That could mean acquiring bank branches. That could mean facilitating a merger with another credit union, investing in other CUSOs, investing in back office technology, right sizing your investment portfolio to get rid of lower yielding investments and bringing on higher yielding investments. And so what we found is it doesn't do a lot of credit unions any good to hold real estate at this low depreciated cost on your balance sheet when you can recognize that gain on sale. You can get all of that capital and you can put that to work for your credit union. And one of the reasons why credit unions we found really never did this before is that until 2022, the accounting rules that were in place for credit unions didn't let you recognize the gain on sale upfront and immediately. And so it really didn't help you as a credit union to sell your branch network, lease it all back, and then just get a fractional portion of that gain on sale every year. But after 2022, when the accounting rules changed, now a credit union can get that entire gain on sale, which is that market value less your book value on your balance sheet upfront and immediately. And so that flows right to net income and net worth. And so what we've seen with credit unions we've worked with is that they're getting anywhere between 50 basis points and over 200 basis points of net worth ratio increase just from something like this. And so that kind of capital for credit unions really is transformative. And we worked with small credit unions that have seen that this is sort of a sale leaseback is like the catalyst that can get them from a level around 100 million in assets to really grow out of that and start to generate year over year growth for the credit union where they really didn't have the flexibility before that to kind of get out of that space just because of how expensive it is to now operate a credit union and comply with regulations.
Mm-hmm.
And so we work with credit unions, large and small, in order to get them that capital through their real estate and through sort of a turnkey solution. So from the perspective of a selling credit union, there isn't a lot of heavy lifting you have to do. We just need to work through the process with you, but ultimately, we want to come up with a solution and a structure that works for that selling credit union. And so, we like to see a credit union, doing a sale leaseback with real estate that they want to continue to utilize. So, from our perspective, we would love to see a credit union leasing that property back for 10, 15, even 20 years with extension options for them. And that way, the selling credit union gets to sort of have full clarity for generations that they will use that real estate. And as a CUSO, we can pay a premium for the stability of a relationship like that by having a longer lease term in there. And so what we've really found is that having, a CUSO that is 100% owned by credit unions as the buyer of this real estate gives sort of a win-win solution for all sides rather than having, a private real estate fund in there that's going to have to give returns to investors and things like that. This really is about generating capital from within the credit union space for other credit unions.
Yeah, and you kind of answered my next question already, but if you could give us a quick synopsis, quick bullet point of the advantages of doing a deal like this.
Yeah, so doing something like this really lets you unlock the capital that you should have access to. But unfortunately, because of the way that accounting rules work and the restrictions on credit unions, you can't tap into that capital. So a sale leaseback allows a credit union to tap into that capital and actually put it to work for your credit union. And so no longer are you kind of sitting there just watching the value of real estate kind of move up and down, but usually up over time. Now you can take that capital and you can put it into your credit union. And so when you think about, what you can do in terms of turning that new capital into earning assets for your credit union, whether that's again, sort of indirectly through investments in technology and back office and other employees and growth that way, or through actually growing your loan portfolio or an investment portfolio, you are, more than offsetting a new lease expense, and now you're generating compounding net income year over year for your credit union through something like this. And so what we found is that, it really doesn't do a credit union any good to have that real estate just sitting there on their balance sheet. This is what allows you to really actually invest back in the credit union. And doing this type of transaction with a CUSO gives credit unions the comfort that you've got a good actor on the other side. And ultimately, we all know that, boards may want that option to buy back the real estate down the road. And so while there are accounting rules that prohibit it from being contractually mandated in a lease, we can promise, right, that you've got a CUSO on the other side. And if a credit union says, look, we've experienced all the growth we think we're going to experience right now in our market, we've got excess capital 10 years from now, and they want to buy back that real estate, that's something that the CUSO is committed to doing to make sure that the credit union is able to put its capital to work how it best sees fit for itself and for its members.
And you mentioned also a bit ago, because I was reading about like Westcom and some of the larger credit unions doing this, but it does sound like you work with all size credit unions, but also almost sounds like the smaller credit unions might even be get more advantage out of doing a deal like this. Does that make sense?
Yeah, I mean, I think when you look at the percentage benefit for a credit union, right, you're going to just see that a smaller credit union can often see sort of outsized benefit from a sale leaseback. And so one credit union that we worked with based in Northern California, they had a $3.5 million gain on sale from their sale leaseback for their headquarters building and flagship branch. And while that may not be a large number for a Westcom or a multi-billion-dollar credit union, for a credit union with $100 million in assets to see a $3.5 million immediate increase in net worth is transformative for them. And
Mm-hmm.
what you can do with that from a assets perspective and a growth perspective and really generating what would have been a decade of income overnight, becomes a really interesting opportunity for a credit union of that size.
Mm-hmm.
But we found that, even looking at, large credit unions, um, whether it's a headquarters building or, a 6 or 12 branch location sale leaseback, it really can become capital that is transformative for them as well
Mm-hmm.
because of what they can do from a growth perspective. And so that's really what it comes down to, I think, from our perspective is, this isn't going to be a good solution for a credit union when you're looking at just a band-aid to stop, losses year over year, and you want to kind of grow your net worth to give yourself another year or two of time to figure something out. This is a great solution when you're a credit union that just needs to get a little bit of breathing room in your capital ratios in order to invest in the credit union. Or if you have sort of a growth plan for the credit union, kind of the things we talked about before, and this capital and this liquidity really gives you the opportunity to put that into overdrive for the credit union.
Well, so obviously you're a CUSO, it's owned by credit unions. What do they get out of this? Obviously they're looking, to benefit from it as well.
Mhm. So we have about 2 dozen credit union owner investors in the CUSO right now. It's a number that we would love to see grow over time as we have an opportunity to grow the CUSO through more sale leasebacks. And what we found is those initial credit union investors really understood how sale leasebacks for other credit unions, could benefit the credit union industry as a whole. And so, the first order of business here, right, is credit unions helping other credit unions. And that's what we think makes the credit union ecosystem so unique when you compare it to any other industry, not just in financial services like banks, but really any other industry where you've got so much cooperation amongst credit unions within your peer group, within your geographical area, and within the, in the broader credit union industry. And so the first order there was these credit unions said, this is an incredible opportunity for credit unions that need capital and liquidity to raise it, and we want to be part of that. But, they're not doing that just out of the goodness of their heart. They need to get something out of that, both for their boards, for the regulators, for their members, and for their employees, and their own stability and growth. And so what do they get out of that? They get out of that a stable quarter over quarter cash yield from being a landlord to the CUSO. And so, because we have long-term leases with well-capitalized credit unions on the selling side of the CUSO, those investor owner credit unions basically just receive that cash flow on a regular basis, and it's something that grows over time because of small lease increases every year. And those credit union owners of the CUSO don't really have to do anything because it's a hands-off landlord relationship, right? We
Mm-hmm.
want the credit union that has sold its branches to the CUSO to keep maintaining those and operating them as they did when they owned them. Those credit unions are best equipped to know what that building needs in order to keep it up for their members and employees. And so we set the lease rate a little bit lower in order to account for the fact that the credit union has those expenses. But then the CUSO really just gets a very stable cash yield because you don't have variability year over year of what's going to happen with this one building, what are my unforeseen expenses. And so it really is a sort of no effort, regular yield on your investment as a credit union, owner of the CUSO. And we set this up in a way where the CUSO is not, the credit union owners of the CUSO are not investing in this sale leaseback and that sale leaseback and onesies and twosies. They're investing in sort of our parent level CUSO. We like to think of that as like an ETF or a mutual fund.
Mm-hmm.
And then that CUSO is what sets up the relationships with every selling credit union.
Mm-hmm.
And so that way, if you're a credit union, investor owner of the sale leaseback CUSO, you get diversification from returns tied to every single sale leaseback that the CUSO, that you as an owner of the CUSO have approved to go forward. And so it really gives you diversification because you're not tied to a single, credit union opportunity. It gives you liquidity because you have one investment. You don't have 15 different piecemeal investments. And it still gives you sort of some of that, we'll call it a decision-making capability because as a CUSO owner, you get to vote on what the CUSO does. And then on the other side of many sale-leaseback transactions, we also have a credit union loan to help facilitate it.
Mm-hmm.
And so sometimes when you're purchasing a property, and again, that's going to depend on the size of the transaction and what the rate environment looks like. But we might purchase a credit union property with some equity and a partial loan, say for 50% of the value.
Mm-hmm.
And so with that loan, we'll have a credit union make a 50% loan to value loan and participate that out to other credit unions.
Okay.
And some of those credit unions are part of the CUSO and some of them aren't. And so now you have, credit union investors getting an equity return. You've got credit union lenders and credit union loan participants getting an incredible loan return as well. Both of those, which we think are perhaps the safest investment or loan for a credit union, because you're lending or investing in underlying, well-placed, well taken care of real estate that's utilized and has been utilized by a well-capitalized credit union for a long period of time. And that is tied to the income coming from that rental income. And as we all know, right, credit unions just are an incredibly safe investment opportunity. They're an incredibly safe group to work with. And no one understands that better than other credit unions, right? And so we really think that, not only is your investment or your loan backed by well-located, real estate, but it's also backed by the income coming from a well-capitalized credit union.
Mm-hmm. And so when I have guests on here, I always offer them the final thoughts, final words. What do you have to say?
We just think that, we know that new ideas in the credit union space take time to generate momentum and for credit unions to get comfortable. And so we've really appreciated the opportunity we've had to date to speak with a lot of credit unions about why something like this can work and can benefit them. And we really just want to make sure that credit unions know there's a CUSO opportunity to do a sale leaseback and that it really can be as good as it sounds, that it really is something that can be transformative for your credit union. There's no hidden tricks, there's nothing like that. It really is just that capital is there, and we want credit unions to be able to access it and to put it back to work for their members and for their own credit union.
All righty. Well, thank you so much, Mitchell, for your time today. I appreciate it.
Thank you. Yeah, I appreciate it. Thanks for doing what you do.